Hi guys, in today's video I'm going to be sharing with you the ultimate step-by-step guide on how to trade cryptocurrency using smart money concept. In this video I'm going to be teaching you how smart money works, and I'm going to be showing you using basic explanation method and a live chat on how you can use this trading strategy to your own benefit. So on the live chat, I'm also going to be showing you the special entry model that I use in trading smart money and how you can also apply it to your own trading. So stick with me guys, and without wasting time, let's dive right into the video. Welcome back to the channel guys. If you're new to the channel, please don't forget to like, subscribe, and also drop a comment guys. Don't forget we have a mission to take the channel to 1K so that we can be able to reach out to a lot of traders out here so that they can also have access to this spectacular trading tips that I share with you here on the channel. So without that said, let's dive right into the video. Okay guys, so for this video, I'm going to be sharing with you 3 important tips that we are going to be using to have a breakdown of this particular smart money strategy. Now, the first thing, it has to be understanding market structure. The second tip is looking at liquidity. And the third thing is something that is very popular in the trading industry. And I know most of you might have heard of it already. They are fair value caps. Now, I'm also going to be showing you how we are going to be combining each and every one of them to make this entire trading model that I am going to bring to you. So now, here on the chart, we're going to look at for market structure. Market structure. Now, when we talk about market structure, we are simply talking about the direction of the markets, respecting a series of build up that is continuous, a pattern that is continuous. Now, when you look at my chart here, you're going to see that we have 3 types of market structure. We have the uptrend or the bullish market structure, we have the downtrend or the bearish market structure, and then we have the consolidation or the ranging market structure. Now, when we talk about the bullish market structure, we're simply talking about a market structure that where the order flow of price is moving towards the upside. And there we can see that we have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Now, you can see that the order of price is continuously flowing to the upside, and that is why we say it is an uptrend. Now, when you look here, you're going to see that we have a consolidation. Here, price is neither going up nor down. Instead, we are seeing that the price is what is ranging within one specific level. So price to be ranging within a specific level like this, a specific level like this, in whatever form. It could be in form of a trend line, it could be in form of equal highs or lows. That is a consolidation rate. Now, when the last type of market structure we have is the bearish market structure or the downtrend. Now, for the bearish market structure, this is just the same with the bullish market structure, just that price is moving, the order flow of prices in the other direction. Here we see the order flow moving towards the downside, and that's why we see prices in a downward trend. So the flow of price is moving towards the downside, creating lower lows, lower highs, lower lows, lower highs, lower low, and lower high. So this is one that creates the structure for the market to sell whenever we want to look for a position. And the same thing goes with the bullish market structure. It creates the structure for us to buy whenever we want to go into position. So that is that for market structure. Now, the next thing is liquidity. Now, let me go over to a fresh page and show you. Now, when you have a bullish market structure, for example, what happens? Now, we notice that we have a series of highs and lows forming. Okay, guys. So we have a higher high, we have a higher low, we have the higher high, we have another higher low, we have a higher high, and we have another higher high right here. Now, most of the times when a lot of traders see this kind of structure, originally we know that the market, this is a bullish market structure, so we are going to be looking for buys. Now, where a liquidity comes in place is that you're going to see a lot of traders who want to be going in on long position from this place, or because the institutions are aware of this particular area. This particular area is going to be used as an area of liquidity. Now, if you want to know more about liquidity, you can click on some of my previous videos and even yesterday, I talked extensively about liquidity, both basic market structure liquidity patterns and complex market structure liquidity patterns. So do well to check out those videos to gain more insight. So now we can see that this particular low here, higher low, which was created, now becomes what? An area of liquidity. And what this simply means is that instead of the price to trade higher from here, we are going to see a drop down to take off this liquidity into an area of demand before the market continues going what's in the intended direction. So that is that for liquidity. So this is how liquidity functions. Now, liquidity could also be in form of equal lows and highs. When I mean equal lows and highs, we are talking about a market structure like this. Take, for example, we are in a bearish trend, or we have a bearish market structure, and we see lower highs and lower lows forming, and then at some point we see a series of price going in this form. Now, right here, we are seeing that what is the market from? The market is creating what? A trend line. And this trend line serves as what? Liquidity. This particular trend line now becomes our what? Our liquidity. So the institutions has to sell off into the market, has to sell off to take out all this liquidities or areas where others are placed that people are expecting to sell from, to use them as liquidity before selling to the final destination. And note that the sell must happen from a valid supply zone. Now, this is for trend lines. We also have a scenario where instead of trend lines, we could also see something like this. We could also see the market. Okay, let me take this back. We also see, instead of a trend line, we could see the market forming something like equal highs and lows. So we have equal lows. We can see equal lows forming here. We have equal highs also. Let me put it straight up and this. We're going to have something like this. So the market is going to use this equal highs as liquidity into an area of supply before selling. And if it's a downtrend, it is an uptrend, is going to use the equal lows as liquidity before going to the upside. So that is that for liquidity. Now, the third thing which we use in this particular entry model in smart money trading is mainly used as a confirmation, and that is fair value gaps. Now, I've also talked about fair value gap extensively in other videos, and do well to check them out if you don't know what a fair value gap is. But quickly, I'm going to talk about a fair value gap now. A fair value gap is the gap that the market creates where we have candle bodies, where we have a successive number of candles closing above each other. So we have a candle close here, we have a candle close and another candle close. This particular gap here that the market creates is what we call a fair value gap. So this gap here is what we call a fair value gap. Now, what is the reason for a fair value gap? Having a fair value gap in a valid trading area simply helps us get more validation that the market is going to mitigate the fair value gap and our demand or supply zone and continue trading in the intended direction. So basically, use fair value gaps as an extra confirmation or conflicts where we are trading. So being able to combine all these three are going to make your this particular entry model a very super entry model for you. So like you see in this previous structure that I drew here, take for example, we can have a fair value gap here, and now we are waiting the expectations for price to come mitigate the fair value you are trading to this area of demand, and then we are going to be buying. And when we are buying, we are not just going to be buying randomly, we are going to be buying targeting the new high that was formed with our stop loss going to be placed just at this protected low. Now, if you look at it, we're placing it that way is going to help us get the maximum reach to reward ratio, because now at this point we know where the price flow is going to. So now let's go to a live chat and let me show you every single thing that we have been debunking right here on the live chat. So now on this live chat, I'm going to be using a live trade that I took, and I also send this trade out on my Telegram channel. So if you're not part of my Telegram channel, do well to join my Telegram channel. It's absolutely free, or we drop free trading signals every day. So all you need to do is just click in the link in the description, and it's going to take you to the Telegram channel where you can be a part of our trading community. Now, this is the BNB USDT pair, and I'm on the 1 hour time frame. Now, what do you notice on the 1 hour time frame? Now, you can see that initially price was bullish, and at some point we had a change of character, which indicated that the order flow has shifted from bullish towards to bearish. Now, after this change of character, what do we see? We see a break of structure, another break of structure. Okay, we see a first break of structure. We have another break of structure. Now, this is what that tells us that, okay, now good and fine, price has shifted from being bullish to now being bearish. So now, what do we have to look out for? We have to look out for liquidity, fair value gaps, and a valid supply zone to trade from. Now, if you look at here, you can see I marked out this liquidity that was taking. This liquidity that was taking is just an extra confirmation that our price has no intention, should have no intention of going back to the upside. No, now after we see liquidity taking, we can also see a liquidity build-up that happened here between this low before our supply zone to the high that we refused to sell off continually. So we mark out this place as our liquidity trap, where we expect price to give false movement down for trading to our suppliers. And just as you see, we see this price movement down, and then we traded into our supplies. On the right here, this was where I took my entry, and this was where I also called the trade on my signal group. And you can see that we triggered this trade and we move straight down to TP. This was a 1 to 4.3, which to work. Also, you can see just to for further proof that we actually took this trade. If you look right here on my screen, you're gonna see the trade. You're gonna see the trade right here on my screen. You can see it with our entry price was at 64674.45, and our exit price was at 629.50, just the same as I have here, and that is what we had here. And we made a 333% ROI using the 50x leverage. So that is that for that on this video, guys. So don't forget, if you've not subscribed to the channel, please don't forget to subscribe, like, and also drop a comment, as this will help to push the channel forward to our mission of getting to 1K. So we all that said and done, see you in the next video. Peace out, guys.